Welcome to this detailed breakdown of the gap retest strategy, one of the most reliable price action techniques used by professional traders to catch big market moves. In this video, we'll explore exactly how this strategy works and why it can give you a clear edge in Forex, stocks, or crypto trading. The chart in the image shows a market that was first moving strongly upward with a series of large green candles. Suddenly, heavy selling pressure appears, and a sharp drop creates a gap, a section on the chart where price skipped over a range without any trading. This empty space, shown between the top of the red candle and the bottom of the previous green candle, is a signal that powerful sellers have stepped in. The area around this gap forms a supply zone, highlighted by the shaded rectangle at the top of the chart. After the initial drop, the market prints a new low, proving that sellers are in control. However, markets often retrace to fill the gap. Price begins to climb back toward the supply zone. This slow climb is called the retest. The strategy recommends patience. Wait for price to return to the retest entry area, which overlaps both the original gap and the supply zone. When price finally touches this zone and starts showing rejection signals, such as wicks or sudden selling, you look for a short entry, meaning you place a sell trade. As the market starts moving down again, there's usually an add to position area, a small pullback where traders can increase their sell positions. The trade's initial target is the next key support level, often near the previous new low marked in green on the chart. The smaller sketch at the bottom of the image summarizes the pattern. An upward move creates a gap. Price drops to a new low, then climbs back to retest the gap before falling sharply again. In simple words, the gap retest strategy is about identifying where big institutions sold aggressively, waiting for price to revisit that same zone, and then joining the sellers for the next strong downward wave, turning market psychology into a high-probability trading opportunity. This image illustrates the breakout retest strategy, a classic price action setup that traders use to enter high-probability trades after a key market level is broken. Here's how it works. First, notice the horizontal line marked as resistance. Resistance is a price level where the market has repeatedly struggled to move higher. Sellers typically step in here to push the price back down. Eventually, strong buying pressure builds and the price finally breaks out above this resistance line. This sudden move above the resistance is called the breakout, and it signals that buyers have gained control and the previous ceiling has been overcome. However, instead of continuing straight upward, price action often pulls back toward the same resistance level it just broke through. This pullback is called the retest. During a retest, the old resistance level now acts as support, meaning that instead of sellers pushing price down from this zone, buyers step in to defend it. If the price holds above this level and shows bullish signals, like strong green candles or rejection, wicks, it confirms that the breakout is real and not a false move. Traders look for this exact moment to enter a long position, a buy trade, because the retest gives a safer entry point with a clear stop-loss area just below the new support. The goal is to ride the next upward wave as momentum continues in the direction of the breakout. In simple words, the breakout retest strategy is about waiting for the market to prove that a key level has truly flipped from resistance to support. By entering after the pullback, traders reduce the risk of getting caught in a fake breakout and increase the chance of capturing a strong, sustained trend. This image shows a classic bearish hanging man confirmation inside a supply order block, OB. After a bearish trend continuation, start by noticing the sharp drop on the left which creates bearish market structure. Then price consolidates into a rectangular order block, OB, where institutional sell orders previously accumulated. After that, price moves down again to form a new low, confirming bearish structure, and then retraces back up into the same OB. This retrace is the setup. While price sits inside that OB, a hanging man candle appears, a small real body at the top of the candle with a long lower shadow. Typically, the wick is at least twice the body, which tells us intraday that sellers pushed price far lower, but buyers only managed to push it back to the top. That failure to sustain buying is an early sign buyers are weakening. The pattern becomes actionable only after confirmation, usually the next bearish candle that closes below the hanging man's low or a clear, rejection wick inside the OB, and that confirmed rejection is what signals institutions are likely re-entering short and the larger drop will resume. Practical entries: enter a short on the confirmation candle's close or on a break below the hanging man low. Place the stop above the hanging man high or above the OB's upper boundary, and set targets at the recent lows or structural support levels. You can scale out at the initial support and trail the rest. Why this is high probability? It combines three confluences: bearish market structure, new low, a supply order block zone, and a bearish price action candle pattern, which together reduce the chance of a fake signal. Still, always use proper risk management and wait for the confirmation candle rather than trading the hanging man alone. This chart explains how to trade a fake out in the market with clear steps. First, you need to identify the key levels of support and resistance. The resistance level is the area where the price struggles to move higher, while the support level is where the price tends to bounce back up. Often, traders place stop orders above resistance, expecting a breakout, and this creates a liquidity zone. Smart money usually takes advantage of this by pushing the price slightly above resistance, triggering those orders. This is called a fake out because the breakout does not continue and instead the price quickly falls back into the range. After the fake out, the price returns to the resistance area and then breaks below the support line. This confirms that the initial move was false, and the real direction is now bearish. When it comes to entries, there are two approaches. The first is the risky entry area, which happens immediately after the price breaks support. While this offers an early position, it carries higher risk, since the market might retest the broken support before continuing lower. The second is the safe entry area, which is more reliable. Here, the price retests the broken support, and once it rejects that level, support becomes resistance. This gives traders a higher probability setup with reduced risk. Before the fake out, the chart shows a clean bullish move, which traps many traders into thinking the uptrend will continue. However, once the fake out plays out, the market shifts and forms a clean bearish move, showing that sellers are in control. Fake outs happen because large players use them to trap retail traders, collect liquidity, and build bigger positions before driving the market in the real direction. The strategy to trade fake outs is simple. Identify strong support and resistance zones, wait for a fake breakout and quick reversal. Confirm the rejection with candlestick signals, and then enter on the retest for a safer position. This allows traders to avoid traps and catch the major market move with confidence. This chart explains the concept of pullback after breakout entry, which is a safer and more reliable trading strategy. At first, the price is moving below a resistance level, where sellers are actively holding the market down. Eventually, the price breaks above this resistance, signaling strong bullish momentum. Once the breakout happens, the previous resistance turns into a new demand zone, meaning buyers are now likely to step in around this level. Instead of entering immediately at the breakout candle, the better approach is to wait for the pullback. The pullback occurs when the price temporarily moves back down to retest the broken resistance, which now acts as support. The entry area is identified when price comes back into the demand zone and shows signs of rejection or bullish reversal candles. This gives traders a higher probability trade compared to chasing the breakout. To protect against losses, the stop loss should be placed just below the demand zone. If the price breaks below this area, it suggests that the breakout has failed, and exiting early helps minimize risk. On the other hand, the initial target is set at the next resistance level or a logical higher point where the market is likely to react again. This method works because breakouts often attract early buyers, but many times the market pulls back before continuing higher. By waiting for the pullback, traders confirm the breakout's strength and secure a better entry price with an improved risk-to-reward ratio. In summary, the pullback after breakout entry strategy allows traders to avoid false breakouts, enter at safer points, and aim for bigger profits with reduced risk. This chart explains the bullish fakeout entry strategy, which is used to identify profitable buying opportunities when price manipulates support levels before moving higher. The process begins with a drop-base rally formation inside a demand zone. This pattern shows that after a drop, the market finds a base where buyers start accumulating orders, leading to a rally upward. As price develops, it creates a support level above the demand zone, which traders watch closely. Eventually, the market breaks below this support level, giving the impression of a bearish continuation. However, this move is actually a fakeout designed to trap sellers and collect liquidity below support. Once the fakeout occurs, the price quickly reverses back above the support level and re-enters the demand zone. This area is the entry zone for bullish traders, as it confirms that the downward move was false and buyers are stepping back into the market. To manage risk, a stop loss is placed just below the demand zone, since a true breakdown would invalidate the setup. The expectation is for price to rally strongly after the fakeout, producing a bullish move toward higher targets. The smaller diagrams at the bottom simplify the concept. The first shows the drop-base rally pattern forming the demand zone, while the second illustrates how the market fakes out below support before reversing and continuing upward. Overall, this strategy teaches traders to be patient and look for false breakdowns into demand zones, using them as high-probability entry points for long positions. This chart explains the concept of trading in break block, a strategy that focuses on identifying areas where price breaks out and then retests before continuing in the main trend direction. The process begins with a clean bearish move where sellers dominate and push the market downward into a key support area. At this stage, there is bullish liquidity resting below the support, meaning buy orders and stop losses are sitting there, which attracts institutional players. Once that liquidity is collected, the price shifts direction and starts moving upward. The upward momentum leads to a breakout, where the market breaks through resistance levels with strong bullish candles. After this breakout, the market forms what is known as a break block, a zone where price consolidates or pulls back slightly before continuing higher. This area becomes very important because it often acts as a re-entry point for traders who miss the initial breakout. The best trading approach is to wait for price to return to the break block zone and look for bullish confirmation signals before entering. This is marked as the entry point on the chart. To protect against unexpected reversals, a stop loss is placed just below the break block area. If the zone fails, it means the bullish structure is invalid. On the other hand, once the entry is confirmed, the market resumes its rally, creating a clean bullish move that leads to the final target above. In short, this strategy teaches that after a strong breakout, price often retests a break block zone, giving traders a high-probability entry with low risk. By aligning entry within this zone, using tight stop-loss placement, and aiming for higher targets, traders can capture the continuation of strong bullish trends.